Crown Prince, who oversees $1.7 trillion in family wealth, has just made a decision that could reshape the next decade of global capital flows. He is preparing to bundle every China-facing asset across his two main sovereign wealth funds into a single new platform. The combined size could reach $700 billion. And just days after that decision surfaced, his country, the United Arab Emirates, announced it is exiting OPEC, the largest oil-exporting alliance on the planet. One of the world's biggest oil producers is quietly saying goodbye to its energy era, and the destination it has chosen for its next chapter is China. OPEC was founded in 1960 and controls roughly 80% of the world's proven oil reserves. The UAE exports about 2.6 million barrels of crude every single day, ranking third among the 12 member states, behind only Saudi Arabia and Iraq. The entire purpose of OPEC has always been to defend oil prices, using production quotas to manage supply, deliberately cutting output to stabilize prices, and keeping pricing power in the hands of producing nations rather than multinational oil companies. That is the order Saudi Arabia, as the dominant member, has always tried to preserve. But the UAE has different ambitions. It wants to expand production. It wants to grab share during what may be the final stretch of rising global energy demand. In multiple rounds of past negotiations, Abu Dhabi argued repeatedly that the existing quota system was unfair, pushing to lift its allowed production by 30 to 40%. That created an unavoidable collision with Saudi's strategy and the broader OPEC framework. Once the Iran crisis opened up a real supply gap, disagreements escalated past the point of compromise. A break was inevitable, but here is the deeper story. On the surface, the UAE wants more barrels. Underneath, it wants independence and transformation. On one hand, its wings have grown. Dubai and Abu Dhabi have become genuine global hubs in finance, trade, and shipping. Abu Dhabi simply no longer wants to defer to Saudi-led collective decisions. On the other hand, 1.8 million barrels per Dalton Y of idle production capacity represents a massive cash flow loss. Before the global energy transition window closes for good, the UAE wants to maximize the monetization of its oil reserves and channel that enormous pool of capital into its Vision 2031 plan, covering new energy, artificial intelligence, financial services, and tourism. For decades, the UAE's main investment destinations have been Europe and the United States. This time, it is turning its gaze toward Asia. Roughly 2 weeks before the OPEC exit, the UAE was already engaged in intensive contact with China. A private jet from the Emirates touched down at Beijing Capital International Airport. The figure stepping off was Crown Prince Khaled of Abu Dhabi himself. Cooperation agreements and strategic memoranda were signed in rapid succession, covering small modular nuclear reactors, AI data centers, lithium battery recycling, and more. The Crown Prince wanted to import Chinese technology and Chinese standards to accelerate the UAE's industrial upgrade. But the most striking move involved money. 3 days after the Crown Prince landed, a $1 billion sovereign wealth mandate sent shockwaves through the global quantitative investment community. The mandate was specifically aimed at Chinese equities. And on the same day, an even bigger story broke. Bloomberg reported that this Crown Prince, who oversees $1.7 trillion in family wealth, planned to pool every China-related asset from 2 major sovereign funds into one brand new investment platform, concentrating firepower for a major bet on China. Those 2 funds are Mubadala, the established veteran, and Limad, the new arrival. Mubadala has invested in China for a full decade, with total assets under management exceeding $330 billion. Its portfolio includes some of the most recognized names in Chinese tech, including ByteDance, Ant Group, and XPeng Motors. This year, the largest equity refinancing transaction in the global auto industry over the past decade, a $5.6 billion BYDH share placement, had Mubadala standing behind it. Limad, by contrast, was launched only at the start of this year. It is directly controlled by the Crown Prince and integrates the $300 billion ADQ portfolio, one of Abu Dhabi's 3 major sovereign wealth funds, If these two funds genuinely merge, result will be a super investment platform with total assets somewhere between $600 and $700 billion. What does that actually mean? In the past, different Abu Dhabi funds operated their China strategies in silos. After consolidation, every strategic move in the Chinese market would draw on a unified strategy and coordinated resources. And because the new platform reports directly to the royal court for strategic planning and positioning, it bypasses the slow approval chains and fragmented decision-making of the past. In other words, the UAE is now treating its China investments as core national strategic assets. So which Chinese assets are Emirati capital targeting? The answer is fairly clear. New energy, artificial intelligence, advanced manufacturing, the leaders and rising stars in each space. As of the end of 2025, just the Abu Dhabi Investment Authority and the Kuwait Investment Authority alone appeared on the top 10 shareholder lists of 36 A-share listed companies with combined holdings worth around 8 billion yuan in market value. The UAE's sovereign funds show particular enthusiasm for Chinese AI. The Abu Dhabi Investment Authority previously led a $65 million round into Chinese AI company MiniMax. And after that company went public in Hong Kong, its position's value rose roughly 6 times. Aramco Ventures, the venture arm of Saudi Aramco, put about $30 million into Zhipu AI before its Hong Kong listing, and that stake is now worth approximately $415 million. There used to be a running joke that Gulf money buying Chinese A shares was walking straight into a tiger's mouth. In reality, the dual A+H listing model remains highly attractive, and Middle Eastern funds have become reliable cornerstone investors with particular focus on AI, technology, and consumer sectors. The pattern is now obvious. Gulf sovereign funds are no longer satisfied with picking up Chinese exposure as a side effect of tracking international indices. They are entering directly as cornerstone investors and strategic shareholders, participating in equity financings and private placements of China's leading tech companies. The UAE is the first mover, the leader in this shift. Data shows that in 2025, Gulf capital accounted for nearly half of all foreign investment flowing into China across primary and secondary markets, with UAE money making up half of that Gulf total. To deliver on Vision 2031, the UAE is not just investing in industrial assets, it is investing in people. Several international admissions officers at major Chinese universities have noticed something striking. The number of Middle Eastern faces on campus has risen sharply, with most students coming from Saudi Arabia, the UAE, Iran, and Egypt. Middle Eastern students used to rank 4th in volume among international cohorts in China, behind East and Southeast Asia, Africa, and the West. Today, students from Gulf countries treat China as the land of the future. The UAE long ago integrated Chinese language instruction into its national curriculum. Starting in 2019, the country scaled up Chinese language programs significantly, including a 100 schools Chinese initiative covering more than 100 schools, with over 70,000 students currently learning Mandarin. And the subjects these students choose to study in China line up directly with emerging industries and advanced manufacturing. Ahmed, an Abu Dhabi student, now pursuing optical engineering in Beijing, combined artificial intelligence, nano-optics, and polarization imaging to develop a swallowable endoscopic capsule. He says the high-intensity Chinese academic environment has accelerated his growth, and the laboratory infrastructure available to him is the most advanced in the field. It is worth noting that only around 10% of these international students receive government scholarships. The vast majority pay their own way, generating real revenue for China's education sector. And as more students graduate and return home, they are likely to become natural allies and ambassadors for China abroad. For Middle Eastern countries like the UAE, they are also indispensable human capital for industrial transformation. There is another related trend: study tours for elite families. Increasingly, middle and upper-class Emirati families are sending their children on short-term programs in China to expose them to factories and companies in new energy and AI, specially embodied intelligence training facilities, AI startup hubs, and university laboratories. After a study tour in Shanghai, students from private schools in Abu Dhabi described Chinese robots as exceeding expectations and genuinely practical, and were stunned that even hotel delivery robots could carry real-time conversations, something they said they had never seen in the Middle East or in Europe. Why is all this happening now? Two structural advantages on China's side. First, while Europe struggles with the cost of energy transition, and the United States places more and more barriers on incoming Middle Eastern capital, China offers complete supply chains, strong resilience, and a stable macro environment, creating a safe haven profile that is increasingly independent from both Europe and the US. Second, the global reach of Chinese industries. In 2025, China exported around 571,900 vehicles to the UAE, including 192,000 new energy vehicles, making the UAE one of China's largest auto export destinations behind only Russia and Mexico. The UAE, the Gulf state with the most urgent transformation timeline, is effectively becoming China's most important gateway into the Middle East for new energy vehicles and other emerging sectors. Whether it can also evolve into a financial connector, for example, by settling oil trade in renminbi to push forward currency internationalization, is the next major question worth watching. The UAE going solo is only the beginning.